The market just turned on a dime. Are you ready for the next move? Welcome to Profit in Peril, where today we dissect the market's sudden rebound. This is not financial advice, but it might just change how you see your portfolio. The Dow, S&P 500, and Nasdaq have all staged a recovery after steep losses, thanks in part to a cooling oil market. But why does this matter? The S&P 500, down 3% year-to-date, is a barometer for the U.S. economy, influencing everything from your 401k to global investment flows. The SPDR S&P 500 ETF Trust, a go-to for broad market exposure, has also felt the heat, down 9%. But not all is doom and gloom. The Invesco S&P 500 Momentum ETF is quietly outperforming, a beacon in rough seas. This recovery is not just about numbers. It reflects the dynamic interplay of market forces and investor sentiment. Historically, market rebounds after downturns have led to shifts in investor strategy, often highlighting sectors that stand to benefit from economic stabilization. For instance, during past recoveries, sectors like technology and consumer discretionary have shown resilience, as investors anticipate increased consumer spending and technological advancements driving growth. Furthermore, the cooling oil market is pivotal. High oil prices have been a significant contributor to inflationary pressures. As oil prices stabilize, it alleviates some of the cost pressures on businesses and consumers, potentially leading to increased profitability and consumer spending, which are critical for a sustained economic recovery. Look at this. The S&P 500's recent bounce is a classic case of market psychology. Investors are relieved by easing oil prices, but the charts tell a deeper story. Notice the candlestick patterns forming a reversal signal. Bulls are cautiously optimistic. Technical analysis shows that key support levels have held, indicating a potential bottoming pattern. The Relative Strength Index, RSI, a momentum oscillator, is moving away from oversold levels, suggesting that the selling pressure is easing. Additionally, volume analysis reveals that buying interest is picking up, providing further confirmation of the bullish sentiment. However, it is essential to remain vigilant, as false breakouts can occur if market conditions change abruptly. Historical data shows that similar patterns have led to short-term rallies, but sustained uptrends require confirmation from fundamental improvements in economic indicators. Let's dig deeper. The S&P 500's performance is a dance of sector giants, from tech titans like Meta to industrial powerhouses like Broadcom. But the real intrigue lies in the Momentum ETF's strategy. It doesn't pick different stocks, it rides the winning waves within the S&P 500 itself. This fund has shown stronger returns over multiple time horizons and better resilience during downturns. Yet, the underlying factors are complex: energy costs, inflation pressures, and shifting investor sentiment. But here's where it gets dangerous. The Momentum ETF capitalizes on the momentum effect, a well-documented anomaly where stocks that have performed well in the past tend to continue performing well in the near future. This strategy is not without risks. Momentum investing can lead to buying at the top of the market and selling at the bottom, especially in volatile environments. The Momentum ETF's success hinges on its ability to swiftly adapt to changing market conditions and rotate into sectors that are poised to outperform. Currently, it has a significant weighting in technology and healthcare, sectors that have shown strong earnings growth and robust fundamentals. However, macroeconomic factors such as rising interest rates and geopolitical tensions could impact these sectors, altering their growth trajectories. For instance, if interest rates rise faster than anticipated, it could lead to higher borrowing costs for tech companies, affecting their profit margins and valuation multiples. Moreover, geopolitical tensions, particularly in regions critical for technology supply chains, could disrupt operations and lead to supply shortages, impacting revenues. These complexities highlight the importance of diversification and dynamic asset allocation in momentum strategies. The Momentum ETF's approach, while promising, requires constant vigilance and a deep understanding of market drivers to effectively navigate the ever-changing investment landscape. Switching gears, let's compare. The sector heat map reveals where gains are concentrated. Tech and consumer discretionary are leading the charge. The divergence in sector performance is stark, highlighting where smart money might be headed. The technology sector is benefiting from strong demand for digital transformation solutions and innovative technologies, while consumer discretionary is buoyed by optimistic retail sales figures and consumer confidence. The heat map also shows underperforming sectors such as energy and utilities, which are grappling with regulatory challenges and fluctuating commodity prices. This divergence suggests a rotation in market leadership, as investors pivot towards growth-oriented sectors with favorable long-term prospects. However, it is crucial to assess the sustainability of these trends, as sector leadership can shift rapidly based on economic data releases and policy changes. Despite the recovery, risks loom large. The energy market's volatility isn't over, and any uptick in oil prices could reignite inflation fears. Short sellers are circling, as seen with Arbor Realty Trust's skyrocketing short interest. The credit landscape is deteriorating, with non-performing loans becoming a focal point. These could be the cracks that widen if investor confidence shakes. Recent data indicates that the global supply chain disruptions and geopolitical uncertainties continue to pose significant risks to market stability. For instance, tensions in Eastern Europe and the Middle East could lead to sudden spikes in oil prices, disrupting the current recovery trajectory. Additionally, the Federal Reserve's monetary policy decisions will be closely watched, as aggressive rate hikes could stifle economic growth and increase borrowing costs. Historical precedents suggest that abrupt policy changes have led to heightened market volatility and investor anxiety. Furthermore, the corporate earnings season will provide critical insights into how companies are navigating these challenges. Any disappointment in earnings or forward guidance could trigger sell-offs, particularly in overvalued sectors. Investors should also be wary of speculative bubbles, as exuberance in certain asset classes could lead to sharp corrections. Therefore, maintaining a balanced portfolio with a focus on quality and diversification is essential to mitigate these risks. So, where do we go from here? A stable oil market might bolster investor confidence, sparking increased trading activity. The potential for a broader market rally is on the horizon, but it hinges on sector stabilization. Long-term energy cost stabilization could temper inflation, but only if geopolitical tensions remain subdued. Analysts project that if oil prices remain stable, it could lead to a more predictable inflation trajectory, allowing central banks to adjust monetary policies gradually. This environment could foster a conducive setting for equity markets, encouraging capital flows into growth sectors. However, the outlook remains contingent on several factors, including fiscal policy measures and global economic indicators. The upcoming G20 summit could be pivotal in shaping international trade dynamics and addressing climate change initiatives, impacting energy markets and corporate sustainability efforts. Investors should also monitor technological advancements and sector-specific innovations, as these could serve as catalysts for economic growth and market expansion. Understanding these shifts can empower your next investment decision. Today's market recovery is a sign of resilience, but not a free pass. Profit or peril? The market's next move could define your financial year. As we navigate the complexities of the current economic landscape, it is crucial to remain informed and adaptable. Historical patterns and emerging trends offer valuable insights, but they also underscore the need for prudent risk management and strategic planning. By staying attuned to market developments and leveraging data-driven analysis, investors can position themselves to capitalize on opportunities and mitigate potential pitfalls. If you found this analysis valuable, hit that subscribe button and ring the bell for more market insights.